Welcome to the deep dive. Our mission today is pretty laser focused. We're going to unpack a whole stack of sources centered on what might be the single biggest strategic shift in the modern economy.
Yeah, it's a big one.
It really is. This isn't just about, the evolution of electric cars anymore. This is the full-scale, aggressive transition from the vehicle as a piece of hardware to autonomous intelligence as a premium recurring service.
We are looking at a pivotal moment here in early 2026. I mean, the whole foundational narrative of one of the world's most watched and, let's be honest, volatile market players, Tesla, is moving decisively away from being seen as a car company.
Entirely.
Entirely. And our sources give us these incredibly detailed views on this aggressive pivot, which we're calling the Great Pivot. We're trying to go beyond just the headlines to look at the dramatic shifted subscription models.
Which is huge. It's massive. And then there's the intense infrastructure hardware battle, the huge energy market tailwinds that are being driven by the AI data center boom, and, naturally, all the investment drama that comes with this level of volatility.
Okay, so let's really unpack this. The core theme, it seems, is the realization that the initial EV revolution has kind of plateaued.
It's hit a ceiling for now.
And that's forcing a company that was born in that revolution to aggressively transform itself into an AI and robotics conglomerate just to justify its, astronomical valuation.
Exactly.
So we're going to break down this new ecosystem, what our sources call the 4 pillars of future revenue, and we'll look at these key moments like what's being called the imminent Valentine's Day inflection that are reshaping not just the auto industry, but the entire value chain. I mean, from the foundries that print the chips all the way down to the commercial insurance sector, the stakes, well, they really couldn't be higher for them or for the market they're trying to redefine. To really get why this pivot is so necessary, you have to start with the cold, hard numbers from the 2025 financial year.
Right.
That initial sort of breathless hype that drove the early EV adoption phase, that feeling that it was all just inevitable, that has absolutely cooled off.
It feels like the market has gotten a dose of reality.
It has. The market has shifted into what we're calling the pragmatic EV phase.
And that pragmatism, it's driven by a few key realities, right? I mean, sticker shock is still a huge problem, especially for mainstream buyers.
A huge problem.
And range anxiety is still a real factor once you get outside of major urban centers. And maybe most critically, the charging infrastructure, particularly here in the US, just hasn't kept pace with the vehicle rollout.
Not even close.
And these practical realities, you can see them everywhere in the 2025 data.
Oh, they are brutally visible in Tesla's preliminary 2025 financial snapshot. Total revenue is estimated at what, around $98 billion?
Which sounds immense on the surface.
It does, but here's the problem. It represents a flat to modest decline year over year compared to 2024.
And what's driving that?
The primary driver of that stagnation, it wasn't just the macroeconomy. It was a clear decrease in total vehicle deliveries. They actually fell from 1.79 million in 2024 to an estimated 1.64 million in 2025.
Okay, so that's an 8.5% decline in volume for a company that is valued on hyper growth, that is. That's devastating.
It is. And it wasn't just volume, it was the profitability of those sales to keep their market share against some really stiffening competition.
Especially from Chinese manufacturers.
Exactly. They had to drop prices repeatedly.
The price war.
The price war. And that compressed their crucial automotive gross margins, which dipped down to roughly 16.5%.
Yeah.
Now, if you contrast that with traditional luxury automakers, or even where Tesla was at its peak, you really see the pressure on those margins.
And that competition, you mentioned BYD, they officially surpassed Tesla as the world's largest battery electric vehicle seller by volume in late 2025.
They did. And all of this puts the company at a critical historical crossroads. The profitability of their core manufacturing business is rapidly eroding.
So this context makes the pivot feel absolutely existential for their long-term growth story. I mean, if the core business is plateauing and the margins are shrinking, where on earth does the justification for a massive tech valuation come from?
Well, this is where it gets really interesting. The CEO has already been signaling the direction for a while. He suggested that people might eventually, and this is a quote, forget Tesla-made EVs after the Optimus humanoid robot reaches maturity.
That's not just a fun soundbite, is it?
Not at all. It's a strategic declaration of identity. The company's future valuation is no longer intrinsically tied to how many Model Ys they can push out the door.
It's about the AI.
It's about how successful they are in commercializing their AI and robotics initiatives. They are selling a vision of future dominance in intelligence, not just in transportation.
So if they are making that hard shift away from being defined as an automotive manufacturer, how do the sources define their new structure? What does that new revenue model even look like in 2026?
Our source material breaks it down very clearly into four primary pillars, and it frames Tesla as more of an ecosystem provider than a pure manufacturer. This is, absolutely crucial for any investor trying to value the stock right now.
Okay, what's pillar number one?
First, you still have the traditional core, automotive sales and leasing. This includes the sales of the Model S, X, 3, Y, and the Cybertruck, plus any income they get from selling regulatory credits.
So that's the legacy business.
That's the legacy business,
Yeah.
and it's increasingly acting as the platform or the foundation for the other, much higher margin pillars.
Right. And based on the 2025 data, we know this pillar is struggling to generate growth, but it's still vital for that initial cash flow.
Precisely. The second pillar is services and other. Now, this is rapidly expanding. It covers the maintenance of the vehicle fleet, their massive and exclusive supercharger network,
And the insurance arm.
and their growing and very profitable insurance arm, Tesla Insurance. This category is basically all about monetizing the installed base after the initial sale.
Then we get to the really big valuation drivers. Pillar 3 must be the one demanding the highest valuation premium right now. AI and software.
Oh, absolutely. This is the big one. It covers full self-driving subscriptions, the licensing potential of their autonomy stack, and all the future revenues that will be generated by the dedicated robotaxi infrastructure, the Cybercab network.
This is the holy grail for them, moving from selling a physical good one time to selling software access continuously.
It is. And finally, you have the quiet giant in the room, the one that's increasingly becoming a critical contributor to the bottom line.
And that would be pillar 4.
That's the fourth pillar, energy generation and storage. This is driven by sales of the Powerwall residential battery, the PowerPack commercial solution, and most importantly, the massive Megapack utility-scale batteries.
And the profitability and growth trajectory of this division are immense, right?
Yep.
And they directly benefit from the other macro trend we're going to get into later, the explosion of AI data centers.
It's a perfect synergy.
So that shift from a capital-intensive manufacturing structure, which is cyclical and frankly low margin, to a scalable, high-margin software-as-a-service and energy business that fundamentally changes the entire financial model.
Completely.
They're moving from worrying about factory utilization rates to monetizing the data and the autonomy stack that they've already spent billions building. The quality of their revenue just changes dramatically.
And the clearest, most tangible proof that this pivot is happening, like right now, is what our sources are calling the Valentine's Day inflection.
Okay, I'm intrigued.
This is a definitive moment where Tesla is walking away from the classic retail model for its single most valuable piece of software.
So walk us through the specifics of the announcement. What exactly changes on February 14th?
The company announced in mid-January of this year, 2026, that starting on February 14th, they will cease offering full self-driving, or FSD, as a one-time upfront purchase option.
They're just closing the door on it?
Closing the door. They're literally stopping the lump sum payment model. And remember, that lump sum price had just been cut to $8,000, down from a high of $12,000.
Which was really a last-ditch effort to try and buoy those upfront sales figures while the software was, still maturing.
Exactly.
So after that date, FSD will only be available via a monthly subscription. The current price is $99 a month, which itself was recently slashed from $199. It feels like a textbook move to maximize adoption and ensure stable, smooth revenue growth.
And that's exactly why the subscription model matters so much.
Mm-hmm.
This transition successfully aligns Tesla with these broader, highly profitable tech trends. I mean, think about Adobe.
Right.
They successfully transitioned from selling a physical box of Photoshop once every few years to mandating a recurring subscription model. The upside for Tesla is enormous. You get predictable recurring revenue, which Wall Street rewards with significantly higher valuation multiples.
And you control the software.
And you have much greater control over the software's long-term valuation. When you own the software, you control the price, and you control the updates.
And from a purely pragmatic perspective, $8,000 upfront is a massive hurdle for a consumer. It's a huge commitment for a feature that, let's be honest, is still actively evolving.
It's a huge ask.
$100 a month, though, that lowers the barrier to entry dramatically. It encourages more of the existing fleet to at least try the evolving software. We know that as of early 2026, only about 12% of the total vehicle fleet currently subscribes to FSD.
A tiny fraction.
Tesla needs that number to be much, much higher to justify the billions they've poured into their AI valuation.
And what's really fascinating here, and maybe a little humbling for the company, is the implication that's embedded in this shift.
What do you mean?
Moving FSD exclusively to a subscription model. It kind of acknowledges a certain reality. The feature is still officially a Level 2 semi-autonomous cruise control system, and Tesla now explicitly labels it as supervised.
Right. It's not a robot yet.
It's not. And this move is a clear departure from the whole appreciating asset idea that the CEO famously pitched back in 2019. He argued the software would become more valuable over time and was therefore worth the big upfront cost.
But by forcing subscriptions, they're basically admitting that the outright purchase model wasn't sustainable for evolving software that still needs human oversight and constant improvement.
It's a tacit admission, yes.
That's a powerful internal correction. But they wouldn't be forcing this commercial shift unless they were highly confident in the product improvements. So what are the technological engines firing up FSD version 14 that gives them this confidence?
The confidence is absolutely rooted in deep technical progress, and that's driven largely by the massive computational infrastructure they've built. FSD version 14, which is in wide release now, is the version that they feel can sustain a recurring revenue model.
Okay, we've seen this phrase thrown around, 10x expansion in neural network capacity. That sounds like a lot of jargon. What does that actually translate to for you, the listener, for the person sitting in the driver's seat?
That capacity expansion means the system can process significantly more data at the same time, which leads to better reasoning.
So it's not just reacting, it's thinking ahead.
It's the difference between a system that reacts to immediate stimuli and one that can build a complex predictive model of the environment around it. So imagine driving through a really densely packed city intersection.
Okay.
The older system might only be able to track the 3 closest cars. The new system, with 10 times the capacity, can track 30 different objects, cars, cyclists, pedestrians, traffic signals, and predict their movements with much greater certainty over a longer time horizon.
And that translates directly to what? Smoother driving.
It translates directly to significant real-world improvements in handling those complex urban environments. It's smoother, it's less hesitant, and it's much more human in its decision-making.
And our sources broke down some really specific improvements in the FSD v14.2 update, which seems to be the version that's slated for this forced subscription push.
Yes, v14.2 represents a major step forward, both in perception and in complex behavior. First, they integrated a fully upgraded neural network vision encoder.
Okay, what does that do?
It allows the system to read higher resolution features. That means it can distinguish subtle details, like a driver's hand signal or a pedestrian stepping off a curb maybe a fraction of a second earlier than expected. This gives the system vastly improved awareness.
That's incredible detail.
It is. And second, they dramatically expanded their emergency vehicle protocols. Previous versions sometimes struggled with sirens and lights. The v14.2 update adds critical, refined behaviors like controlled pullovers to the side of the road and smart yielding for police cars, fire trucks, and ambulances, even if the origin of the sound isn't immediately visible to the cameras.
That's a huge safety win.
It is. And perhaps most importantly, decision-making has been enhanced in those scenarios that often trip up semi-autonomous systems.
Like what?
Unprotected left turns across busy traffic, tricky lane changes in high-speed traffic, dealing with other vehicles cutting you off, and complex interactions with school buses. The objective is for the system to perform in a very smooth and comfortable manner, achieving the quality of driving that early testers often describe as
Better than some humans.
better than some human drivers, particularly those who might be prone to road rage or just aren't paying attention.
Okay, so the subscription model monetizes the existing consumer fleet, which makes the base business more profitable. But the real prize, the thing that's fueling the most bullish investor targets, has to be the robotaxi network.
That's the vision.
Recurring revenue, 247. So the next critical catalyst here has to be the actual launch of the dedicated autonomous vehicle platform.
That catalyst is looming large. The April 2026 launch of the Cybercab. This is the dedicated robotaxi, a vehicle designed purely for autonomous ride-hailing with no human controls necessary, and it's slated for mass production at Giga Texas.
And its successful deployment is seen as a make-or-break moment for them.
Absolutely. It's make or break for the entire AI narrative that the company has built its valuation on.
The optimism is palpable. I mean, I saw analyst projections that sound almost like science fiction.
They are very high. Morgan Stanley, for instance, is projecting an autonomous vehicle fleet scaling to 1 million units by 2035.
A million units.
A million units. If that happens, you're not just looking at a few billion in revenue. You're looking at a market-dominating mobility platform. That single metric is the primary fuel for the strong retail investor enthusiasm right now. They're all betting on a winner-take-all scenario.
And this is a big but. Getting the technology to work in a geofence test area, or even having it functional on the consumer side with supervision, that's one thing.
Right.
Getting permission to deploy it unsupervised 2047 in the real world, that's a whole other ballgame. This brings up the question that the value bears constantly point to. Can the regulatory environment possibly keep up with the speed of this technology?
That is the highest hurdle, and it acts as this massive double-edged sword for incumbents like Tesla. Commercializing truly unsupervised FSD requires slow, litigious, state-by-state approval in the U.S.
So every city, every state has different rules?
Every city, every state, every locality has different rules on liability, speed, and operation. This regulatory friction, it just naturally slows down commercialization significantly.
And the regulatory scrutiny is already aggressive.
Right.
This isn't just a hypothetical problem.
Not at all. The NHTSA, the National Highway Traffic Safety Administration, has been relentless. They've opened these high-profile investigations related to crashes and traffic violations involving FSD, and they found roughly 80 specific violations in their various probes.
What kind of violations are we talking about?
Often things like improper handling of emergency vehicles, phantom braking events, or failure to follow traffic signals. But while this ongoing scrutiny is a challenge for Tesla, the crucial thing to realize is that it creates a very high protective barrier to entry. We call it a regulatory moat.
A regulatory moat. So, because the standard for approval is so rigorous and so data-intensive, companies that have already accumulated millions and millions of miles of safety data are better positioned to eventually succeed.
That's exactly it. The immense amount of real-world data logged by Tesla's fleet, even when it's in supervised mode, is their single strongest asset when they go into these regulatory applications.
Yeah.
Any newcomer without that decade-plus of data accumulation faces an almost insurmountable hill. The high regulatory hurdle keeps the competition out.
We're also seeing some legislative efforts trying to bridge this gap between rapid innovation and painfully slow regulation, which is, vital for the entire sector's future.
We're tracking one key effort, Congressman Lada's draft of the Self-Drive Act of 2026. This legislation is explicitly intended to streamline the autonomous vehicle certification process
And modernize the NCAP.
and modernize the new car assessment program, or NCAPP. For listeners who aren't familiar, NCAP is basically the government's vehicle safety rating system.
The star ratings you see on new cars.
Exactly. Modernizing it means creating standards that account for the unique safety features and risks of autonomous systems, rather than just applying old crash test metrics. If this act gets enacted, it would make the path to full, unsupervised deployment much clearer and potentially much faster for the companies who are ready to comply. It shows the government is trying to foster American leadership in this new era.
Okay, let's shift the focus globally for a minute, because Tesla isn't running this race in a vacuum. How does the competition stack up, and what's the key difference in philosophy between, say, the East and the West?
The global competitive landscape splits into two very distinct ecosystems. And if you're an investor, you really need to understand this divide because it completely dictates the risk profile.
Okay, so let's start with the U.S.
In the U.S., we have the software-first approach. This is dominated by massive tech conglomerates like Alphabet, the parent of Waymo, and Amazon, the parent of Zoox.
And Waymo is the established frontrunner here, right?
They are. They are the frontrunner in commercial AV services. They have a fleet of over 2,000 vehicles operating 2,047, driverless ride-hailing in various geofenced zones across Phoenix, San Francisco, and other big cities. They have logged tens of millions of fully driverless miles since 2019.
And their approach is always characterized by extreme caution and data rigor. They usually operate within very tight boundaries.
Precisely. They are conservative. They are focused on solving general autonomy within a specific controlled zone before they even think about expanding. Amazon's Zoox is following a similar path, having started free robotaxi rides in Las Vegas just last year.
So the investment thesis here is paying a massive premium for a data moat and an aim to solve autonomy with maximum safety, even if it means slower growth at first.
Yes. And then you have the Eastern approach, what our sources call the China commercialization speed run.
Which sounds like the exact opposite.
It's the complete opposite philosophy. You have companies like WeRide and Pony.ai moving at a blistering pace commercially. They are heavily supported by government tailwinds that are actively designating huge urban zones for robotaxi operations, often fast-tracking the approvals.
So they're less focused on a perfect data moat and more on just rapid deployment and generating revenue.
Much more. A great example is WeRide's recent collaboration with Uber. This demonstrates a clear strategy of layering their AV technology into existing global ride-hailing platforms, rather than having to build the entire mobility service, the app, the payment system, the customer base from scratch, which is what Tesla and Waymo are trying to do.
So the investor choice is really stark. Do you bet on the high valuation software moats, the geo-fenced safety, and the rigorous data advantage of the U.S. giants? Or do you chase the explosive but maybe riskier revenue growth of the pure-play Chinese firms that are being accelerated by government policy?
It's the classic trade-off. It's established dominance versus the pure speed of commercial deployment.
When we talk about autonomy, we spend all our time discussing the software, the FSD stack, the algorithms. But the entire system relies on these foundational high-margin components.
That's right.
And if we think of this as a kind of gold rush, these components are the essential picks and shovels trade. You can bet on the miners or you can bet on the people selling the tools.
That's a perfect analogy. The AV sector needs immense computational muscle, both for the vehicle itself and for the vast data centers where the AI models are trained.
And that's where the hardware battle comes in.
It is. The fight for hardware dominance includes the battle between self-driving computers, Tesla's internal D1 and Dojo hardware, versus external vendors like NVIDIA. And NVIDIA maintains a very strong dominance in the data center boom, supplying the GPUs that are necessary for the immense AI training data sets that underpin FSD and Optimus. The sheer volume of data needed for V14's 10x capacity is just staggering.
But our sources point out a key company that often gets overlooked in all the NVIDIA hype, which is the actual foundry that fabricates these cutting-edge, high-demand chips.
That would be TSMC Taiwan Semiconductor Manufacturing Company. They are the foundry running the entire AI boom from backstage. What's often missed is that TSMC quietly outperformed NVIDIA in 2025.
Why is that?
Because every single AI player, NVIDIA, AMD, even Tesla to some degree, is reliant on TSMC's advanced node technology to produce their complex chips. They are the essential bottleneck controller. Their strong guidance supports the stock's hot start to 2026. If the autonomous revolution requires advanced chips, TSMC is the foundational, indispensable component.
And beyond just raw processing power, autonomous vehicles and smart infrastructure require seamless, high-speed, and ultra-reliable connectivity.
Absolutely. Connectivity is vital for V2X, which stands for Vehicle-to-Everything Communication. This enables cars to talk not just to each other, which is V2V,
Right.
but crucially to traffic lights, to roadside units, and to the network grid itself. That's V2I, Vehicle-to-Infrastructure.
So why does V2X matter so much in the real world? What does it actually do?
V2X provides a level of awareness that cameras and radar simply cannot achieve. For example, a car can receive a signal from a traffic light that's around a blind corner, telling the car the light is about to turn red.
So it can brake smoothly long before it can even see the signal.
Long before the driver or even the vision system sees the signal. And this requires specialized hardware. The automotive smart antenna market alone is projected to be worth something like $5.2 billion by 2030, driven entirely by these V2X requirements.
And companies are already moving into this space.
They are. Companies like Skyworks Solutions are pushing heavily into advanced radio frequency, or RF, components for V2X, and specific smart city technologies like Wi-SUN and LoRaWAN, which enable low-power, wide-area network communications for sensors and non-critical infrastructure.
So they're diversifying.
Their new automotive-grade portfolio, which they launched recently, highlights their efforts to diversify beyond smartphones and into these highly specialized, high-growth infrastructure and transport connectivity segments.
Now, let's connect this hardware discussion to the bigger macro picture. The massive, ongoing build-out of AI data centers, the ones that need all those NVIDIA and TSMC chips, creates this massive secondary tailwind for the fourth pillar of Tesla's business, Tesla Energy.
Yes.
This is a brilliant synergistic connection.
This connection is profound, and I think it's largely unrecognized by investors who are solely focused on vehicle sales.
Yep.
AI data centers consume vast amounts of power, Their demand is massive, and crucially, it's often erratic, which destabilizes the electric grid.
And to ensure uptime and grid stability, these data centers need enormous battery backups.
Precisely.
So the AI boom directly powers the demand for high-capacity battery storage.
Exactly. And Tesla Energy, with its utility-scale megapack division, is capitalizing on this macro trend perfectly. It is a surging division. Energy deployment soared 84% year over year. The demand is so high that the next generation, the Megapack 3, which is designed for even higher capacity and faster deployment, is already set for production in the second half of 2026. This high-margin business offsets the slowing EV core, creating that closed loop we talked about earlier.
And Tesla is clearly focused on securing the supply chain for these megapacks domestically, which is essential for maximizing incentives and reducing geopolitical risk.
That strategic push is centered on their domestic lithium refining capability. Their Texas lithium refinery is now fully operational and is described as the largest in the U.S.
And what sets this facility apart isn't just the scale, right? It's the refining process itself.
Exactly. It converts raw spodumene ore directly into battery-grade lithium hydroxide using a simpler, less expensive, and critically, a more sustainable process.
And less expensive refining directly impacts their cost of goods sold, making those megapacks even more profitable.
Precisely. And this cleaner method eliminates hazardous byproducts. Instead, it produces anhydride, which can be recycled and used in concrete mixes.
That's a huge selling point.
This sustainability factor is highly appealing to utilities and large corporations buying the storage. And on top of that, the U.S. Inflation Reduction Act provides vital financial incentives, like the 30% investment tax credit for standalone battery storage systems, which is just accelerating this deployment faster than almost anything else. It's a vertically integrated solution designed to capitalize on the AI energy crisis.
That is a comprehensive ecosystem. But there's one more piece of the puzzle being fundamentally disrupted by autonomous intelligence, and that's the liability landscape, insurance.
The AI insurtech revolution is already underway because the shift in liability is monumental. When a human is driving, the liability falls on the human or their insurance company.
Simple enough.
But when the computer takes the wheel, be it a Tesla, a Waymo, or an autonomous commercial truck, liability shifts entirely from the human driver to the system provider.
How does that fundamentally change the way you underwrite risk?
It changes everything. Insuring a human involves assessing historical risk factors, age, driving record, location. Insuring an AI system involves assessing the software stack, the amount of data logged, and the failure rate of the perception system. This is a massive structural disruption for the traditionally slow $1 trillion commercial insurance industry, which is highly manual and bureaucratic.
And what's fascinating is how quickly startups are using AI to target the manual inefficiencies that plague traditional commercial brokers.
We're seeing a rise in what they call AI-native insurtech startups. Take Panta and Harper, for example. They are building fully autonomous commercial insurance brokerages that are run almost entirely by AI agents.
Zero data entry.
Panta's stated goal is to operate with zero data entry, replacing the armies of brokers who traditionally spend, 80% of their time on manual data scrubbing, cross-referencing, and administrative work. By replacing that manual labor with autonomous agents, they're aiming for significantly higher margins. It's a service business with software economics.
And the innovation is in automating those specific complex workflows that were historically bottlenecks.
Exactly.
Yeah.
Look at the supporting companies. A company called Amera automates claims processing for health insurance payers, turning messy claim inputs like PDFs and receipts into structured, usable data. Or consider Acolyte, which focuses on building AI teammates to handle submissions in the critical process of certificates of insurance or COI issuing across any management system.
Okay, for our listeners, why is issuing a COI such a bottleneck that it needs AI to streamline it?
A certificate of insurance is just proof of coverage. It's often required instantly when a commercial client like a plumber, a contractor, or a shipping firm starts a new job.
Right.
Traditionally, requesting, verifying, and issuing a COI required a broker to manually check policy limits, confirm compliance, and send the correct paperwork. It's slow, it's repetitive, and it's subject to human error.
And Acolyte's AI just handles this instantly.
Instantly, reliably, and at scale. It shows a rapid focus on streamlining that expensive, complex $1 trillion commercial insurance sector. The entire industry is recognizing that AI allows for more granular risk pricing and much more efficient handling of these massive liability shifts.
Okay, so given all this volatility, you have a plateauing core business, but it's offset by these massive AI and energy opportunities. How is the market currently digesting the investment story for a stock like TSLA?
The picture is extremely mixed. It's highly volatile, but the long-term track record gives the stock an almost impenetrable momentum. While TSLA had somewhat mixed one-year returns in 2025, ranging narrowly from 8.8% to 17.70%, its performance over the long haul remains the fundamental argument for the bulls.
Astonishing is indeed an understatement here. I mean, if we look at the 10-year horizon, the total return is a remarkable 3,033.43%.
Yes, and that represents an annualized return of 40.94% over the last decade. It has vastly outperformed the S&P 500, which yielded a 14.88% annualized return over the same period.
And that longevity of disruptive outperformance is why the stock is still treated as an entirely different entity than any legacy automaker, despite the recent slowdown in the EV core.
Exactly.
What stands out to me is the fundamental philosophical split in investor sentiment today. The market is arguing fiercely over what kind of company Tesla even is anymore. It's truly split between the AI bulls and the value bears.
That's the key debate driving all the volatility. On one side, you have the AI bulls, prominently Wedbush, who maintained a massive $600 price target in December 2025.
$600.
$600. They value Tesla as an AI company, akin to NVIDIA or Microsoft. Their valuation isn't based on 2025 car sales. It's based on some of the parts valuation from FSD licensing, the potential recurring revenue of Cybercab, and the potential value of Optimus and the data moats. They're betting entirely on the exponential nature of AI software and that winner-take-all scenario.
Okay, but wait. If the long-term returns are 3,000% over 10 years, how can the bears possibly argue against that growth story? Where is their critical vulnerability?
That's a great question. The value bears, and this includes firms like Morgan Stanley with a price target of $425 and Goldman Sachs at $400, they focus almost exclusively on the short to midterm cash flow and execution risk.
The here and now.
The here and now. They highlight the slowing automotive core, that 8.5% delivery decline in 2025, and the immense execution and regulatory risks associated with true autonomy. Goldman Sachs specifically cited deep concerns over potential regulatory challenges in major markets like California regarding the autopilot system and FSD deployment.
So for the bears, potential future profits just don't matter if they can't successfully navigate the present regulatory and competitive minefield.
That's their argument.
Despite this huge divergence in price targets, institutional activity remains dynamic, which suggests major players are positioning themselves for whatever outcome prevails.
Absolutely. Institutional ownership surged throughout 2025, which is a bullish signal of institutional acceptance. By the end of Q3 2025, 99 hedge funds reported holding TSLA in their portfolios. That's a significant jump from 85 the previous quarter.
So they're positioning it with the other tech giants.
They are. They're positioning Tesla right alongside other AI-driven tech giants like Amazon and Microsoft. Meanwhile, retail investor sentiment appears largely bullish, and it's primarily driven by that long-term vision in AI, robotics, and the cybercab concept. They often overshadow those near-term fundamental concerns about the traditional EV business.
So for our listeners who are trying to navigate this high volatility, high stakes market, what are the 3 critical watch points for 2026? What should they be monitoring to gauge the success of this great pivot?
Okay, the focus has to be on execution and monetization potential, not just on announcements. First, watch the execution risk of the April 2026 Cybercab launch.
That's the big one.
This is the moment where the AI promise has to transition from being a perpetual R&D project into a revenue-generating product line. They must hit this date successfully. Any significant delay could severely impact investor confidence and validate the concerns of the value bears.
Okay. Second, the traditional auto business isn't dead yet. Volume still matters for cash flow and for serving as the data collection platform.
That brings us to the Model 2 unveil in Q2 2026. This is the potential $25,000 consumer vehicle. Success here could reignite the volume growth for the struggling automotive segment and prove they can compete effectively and profitably in that new, hyper-competitive, pragmatic EV phase.
So if they can't deliver an affordable EV successfully, they lose the foundation for the software play.
You do. And finally, the Holy Grail.
Yeah.
The thing that justifies the true AI company valuation premium.
What's number 3?
The third is the ability of the company to pivot completely to software licensing, or what's being referred to as driver as a service. The ultimate prize is not selling 1,000 of their own cybercabs, it's licensing their autonomy stack to 10 other major global manufacturers, turning their competitors into customers.
That's the real endgame.
This ability to generate recurring revenue without the immense capital burden of manufacturing commands the highest valuation multiples in all of technology. So you need to watch for any indications of licensing deals or regulatory approval that enables this expansion.
So what does this all mean? Our deep dive confirms that 2026 is less about selling physical cars and much more about selling software, intelligence, and robotics.
That's the bottom line.
Tesla is placing a high-stakes, multi-billion-dollar bet on transforming into a high-margin service business. It's fundamentally shifting the entire liability landscape for the insurance industry and changing global logistics through autonomous trucking, which is also quietly advancing through FSD technology.
Precisely. The volatility is so high because the stakes are unprecedented. Investors are no longer valuing metal stamping plants and quarterly delivery numbers. They are valuing neural networks, data moats, and the commercial speed of robotaxi deployment in both the competitive U.S. landscape and the explosive Chinese markets.
The whole value chain has changed.
It's completely changed. And it's rewarding the foundational hardware providers like TSMC and the disruptive insurtech startups that can handle that massive liability shift.
We've established that the Model 2, the affordable consumer EV, is due for an unveil in Q2, and the Cybercab, the dedicated robotaxi, is due for production in April 2026. Considering the struggle in core vehicle sales, here's the final question. If both of these launch successfully, will the next decade of TSLA's value be driven primarily by the millions of units sold in the affordable consumer market, which reignites their volume, or the potential high-margin recurring revenue stream generated by the robotaxi network and software licensing?
It's the ultimate choice between volume growth and scalable software profit.
It is something for you to mull over as you track the announcements and, more importantly, the execution throughout this pivotal year.